Hello guys. So today let us start with the chapter called depreciation and depreciation provisions and reserves. Okay, it is chapter 9 from your book. So let us start with the problem number 1. A company whose accounting year is the calendar year. Calendar year is nothing but January to December. So January to December is the year which we need to consider for calculation of depreciation in this question. So a company whose accounting year is the calendar year purchased on 1st April 2004 machinery costing rupees 30,000. It purchased further machinery on 1st October 2004 costing rupees 20,000, and on 1st July 2005 costing rupees 10,000. On 1st January 2006, one third of the machinery installed on 1st April 2004 became obsolete and was sold for rupees 3,000. Okay, so show how the machinery account would appear in the books of the company, it being given that for machinery was depreciated by fixed installment method at 10% per annum. Okay, fixed installment method is also called as straight line method. So in this case you will calculate the depreciation on the original cost of the machinery every year. On the original cost of the machinery you need to calculate 10% every year, that is per annum. Okay, so let us start with the solution. So as a part of the solution, step 1 is, as you're seeing on the screen, that you need to draw a line format thing and you need to place the things what are happening on which date what is happening. So what is happening, that you need to start a year from 2004, that is January to December. So you have to start a year with 1st January 2004, and in the year 2004 on the 1st April 2004 you are getting into the business, that is machinery 1. So we will name it as machinery 1 because there are 3 machineries we are purchasing in this question. So machinery 1 on 1st April 2004, that is with the amount of rupees 30,000, and what is given in the question next, that is on 1st October 2004 you have purchased another machinery with amount of rupees 20,000. So M2 20,000 on 1st October 2004. So after 1st October 2004 there will be the due date, that is 31st December 2004, on which date we need to calculate the depreciation. Okay, so after that again another year will get started, that is 2005, and in the year 2005 what you have done, that you have purchased on 1st July 2005 you have purchased another machinery, that is machinery 3 with the amount of rupees 10,000, and in 2005 there is no other transaction, and the due date again, that is 31st December 2005, on which date you need to calculate the depreciation again. And the next year that starts with 1st January 2006. So in the 2006 what you have done, on 1st January 2006 you have sold one third of the machinery installed on 1st April 2004. So on 1st April 2004, that is machinery 1, you are selling the machinery 1 of amount 30,000. Out of that 30,000 you are selling one third. Out of that 30,000 you are selling one third, that is 30,000 into 1 by 3, which comes to 10,000. So 10,000 amount of machinery you are selling out of the business, and you are getting 3,000 amount for that sale. Okay, so like this you have to record all the things in the line format so that you will not miss any transactions while doing the working notes. So this is the first step in your question, solving the solution. So next one, the next step is doing the working notes for each and every machinery. Okay, for each and every machinery you need to do one working note based seeing on the line format scenario, seeing the line format things you need to calculate. So what in let us make a working note of machinery 1. So calculation of machinery 1. So what is the thing has happening in case of machinery 1? Cost of machinery 1 is 30,000. So we are purchasing on 1st April 2004, cost of machinery 1, that is 30,000. So in case of machinery 1 there is no change in this year 2004. So what is the due date next? That is 31st December. So on this 31st December you need to calculate the depreciation. So depreciation at the rate of 10% you need to take first. for the year 2004. So from which date you need to take that? Depreciation 10% for 9 months, that is 1st April 2004 to 31st December 2004. So April to December, 9 months. For 9 months you need to calculate the depreciation for the year 2004. So 30,000 into 10% into 9 divided by 12. So 2250 you will get the depreciation amount. And next, what is the net balance amount in the balance sheet for the machinery 1 will be appearing, that is 27,750. So in the 2005, what in case of machinery 1, there is any change in the line format? Can you see any change? There is no change. There is no change. So there is no change for machinery 1 in the year 2005. So in the year 2005 you need to take the full depreciation, because the machinery is existing from 1st January to 31st December. Okay, so depreciation at the rate of 10% for 12 months, that comes to 3,000. Because it is a fixed installment method, you need to calculate the depreciation on the original cost. Okay, so 30,000 into 10% into 12 divided by 12, that is 3,000. Okay, so this year depreciation, again you need to deduct it from the cost of the machinery, that is 27,750 is the balance we are having now. So from that balance you need to deduct 3,000 rupees. We will get the net amount of machinery as on 31st December 2005, that is 24,750. Okay, so in the starting of 2006, that is in the 2006, there is any change to the machinery 1? Yes, there is a change. That is, we are selling 1/3 of the machinery. We are selling 1/3 of the machinery 1 for rupees 3,000. Okay, so for this we need to make some other separate calculation. That is, first take 1/3 of machinery sold on 1st April, 1st January it is not 1st April. I have taken wrong date here. So make it as 1st January 2006. Okay, 1st January 2006 you are selling the machinery. So here you need to make some other working note for the sale of machinery. So what is the amount value of machinery 1 you are selling? That is 1/3 of 30,000, which comes to 10,000 rupees. Okay, so 10,000 rupees we are having since 2004. So what is the, in 2004 we are having 10,000 rupees, but as on this 31st December 2005, the amount will be changed, right? The amount will get changed because of the depreciation. So now for this 10,000, calculate the net amount which comes as on 31st December 2005. Okay, so then you need to take the depreciation for the year 2004, that is for 9 months, and depreciation at the rate of 10% for the year 2005, that is for 12 months. Right, 12 months, right? So 750, and you will get 1,000 as depreciation, and the value as on 31st December 2005 or value on 1st January 2006 is the same, right? So there is a 1 day gap, that it will be the same amount. So 31st December closing amount is equal to opening balance as on 1st January 2006. So here the value on 1st January 2006, you will get it as 8,250. Okay, so this amount of 8,250 on 1st January 2006, you are eliminating from the books. So in the working note number 1, you need to eliminate this 8,250 amount. This 8,250 amount you need to deduct from the total machinery value, that is 24,750. we got the value as on 31st December 2005. It is of whole 30,000 amount, we got 24,750. So from that 24,750 we need to eliminate the 10,000 amount of value. The 10,000 amount of value as on today, what we are getting, that is 8,250. So that amount we need to eliminate first, that is 24,750 minus 8,250. And depreciation we need to calculate. For this year, the depreciation on the remaining balance we need to calculate, right? So what is the remaining balance? That is 30,000 minus 10,000. So depreciation we need to calculate on original cost. So from 30,000 you need to eliminate the original cost only. So 30,000 minus 10,000 is the original cost of the selling machinery. So 30,000 minus 10,000 into 10% into 12 divided by 12. See, for this 20,000, the machinery is existing for the full year. So for this 20,000 you need to take the depreciation for 12 months. So you will get 20,000 into 10% into 12 divided by 12, you will get 2,000. So you will net all deducting on all these amounts. So balance as on 31st December 2006, you will get 14,500. So till here you cleared. So in the working note number 2, what you are doing, that you got the 8,250. After this 8,250 you are selling, this is the cost we got, that is 8,250 is the cost we got as on 1st January. But 8,250 amount of machinery we are selling at only rupees 3,000. So 8,250 is the cost, but we are selling only for 3,000. So remaining balance amount is the loss to us, because we are not recovering the whole amount of 8,250. We are only recovering only 3,000 rupees. So this 5,250 will be the loss for us. Okay, this 5,250 will be the loss for us. So it is called a loss on sale of machinery. Okay, so till here you have done the machinery 1 working note. Okay, so next you have to do the machinery 2 working note. Okay, after this I will tell the journal entries, and thereafter you can record the ledgers. Okay, so next machinery 2. So next, see at the step 1, that is the line format. So in the line format, what is happening for the machinery 2? In the year 2004, on 1st October you are purchasing the machinery 2. Okay, for rupees 20,000. So cost of machinery 2 as on 1st October 2004 will be 20,000, and for this 2004 year you will take the depreciation only for 3 months. See, after October you are getting the due date for depreciation, that is 31st December 2004. Okay, so for this 3 months you need to calculate the depreciation, that is 20,000 into 10% for the 3 months, that is 3 divided by 12. You will get the amount of rupees 500. Okay, so after this 20,000 minus 500, you will get the net amount of machinery, net cost of machinery in the balance sheet, that is 19,500 as on 31st December 2004. So next, in the 2005, is there any changes to machinery 1 in machinery 2 in the line format? No, there is no changes for machinery 2 in the line format. So as it is, you can take the depreciation for the whole year without making any changes now. Okay, the depreciation for 10% for 12 months, that is from 1st January to 31st December, that comes to 20,000 into 10%, 2,000. Okay, we are doing SLM method, that is fixed installment method. So we need to calculate depreciation on the original cost always. What is the original cost? On that only you need to take the depreciation. So 19,500 minus 2,000 comes to 17,500 is the net cost of the machinery in the balance sheet we are having as on 31st December 2005. Okay, next, in the year 2006, is there any change to the machinery 2 in 2006 in the line format? So no, we have not recorded any change in the line format in case of machinery 2 in the year 2006. So in the year 2006 also you can take the depreciation as it is on the original cost for the full year, that is amount of 2,000. So next comes to the balance amount as on 31st December 2006 in the balance sheet, that is 15,500 will be the balancing figure. Okay, like this you have solved the machinery 2 amount calculation. And next comes to machinery 3. So machinery 3 in the year 2004 we have purchased. Is there any scenario regarding the machinery 3? No, we have purchased the machinery 3 in the year 2005. So now let's see from the year 2005 only. So make a separate working note for the machinery 3. So cost of the machinery as on 1st July 2005 we are purchasing with amount of rupees 10,000. right? So next comes to due date, because there is no change in that year for the machinery 3. So next comes to due date only, that is 31st December. You need to calculate the depreciation for 6 months, that is from 1st July to 31st December. 6 months you need to calculate the depreciation, which comes to 10,000 into 10% into 6 divided by 12, that is 500. So 10,000 minus 500 is 9,500 is the amount of machinery 3 as on 31st December 2005, which goes to the balance sheet. Okay, this is the balance amount of machinery. And next, in the year 2006, is there any change for machinery 3? No, there is no change in case of machinery 3. So as it is, you have to take the depreciation for 12 months without making any changes, that is from 1st January to 31st December 2006. That comes to 10,000 into 10% into 12 divided by 12, 1,000 rupees will be the depreciation. Okay, so 9,500 minus 1,000 comes to 8,500 is the balance amount as on 31st December 2007, or 31st December 2006 or 1st January 2007. Okay, so like this we have taken the working notes of machinery 1, 2 and 3. After this, seeing the working notes or seeing the line table, you can line format which we have drawn, only step 1 will help you always. See, by seeing the step 1 you will come to know that how many months you need to take the depreciation, what is the change we are getting. See, each and every time we need not see the question what is happening for the machinery 1, 2, 3. Okay, if you draw the line format like this as I given in the solution, if you draw like this, you should always see the line diagram, and you will come to know that what is happening easily. Okay, because every time reading the question again and again will make your time waste. Okay, so like this, if you draw the line format, you will come to know each and everything regarding each and every machinery, what is happening and what is the due date. Okay, that, and you can easily calculate the number of months. Okay, like this, while reading the question only you need to make this step 1 line diagram, so that it will be very easy to you to continue to this working notes and well as ledgers. Okay, next one is this journal entries I have given for your reference purpose only. In the examination you may not write this journal entries, you need not write this journal entries, you need to prepare only the ledger account. Okay, only for your reference and easy to understand I have given these journal entries here. Okay, so see the line diagram, that is on 1st January, is there any change? There is no change, or no machinery came into the business. On 1st April 2004, machinery 1 is coming into the business. So on 1st April 2004, what will be the journal entry? That is, machinery is coming in real account, so machinery account debit 2 we are paying through bank. Okay, because this is a huge amount, we will make the purchases through bank only. You can record as cash also, but it is better to prefer the bank in these cases if you are preparing these ledgers for these huge amounts. Okay, so take it as a bank machinery account debit to bank account as on 1st April 2004. Okay, while preparing the machinery account, so machinery is on the debit side. See, after combining all this, you can take the balances in the ledger. So first try to understand these journal entries. So first, on 1st October 2004, what is happening in the line diagram? That is, machinery 2 is coming in. So what would be the next entry? That is, machinery 2 account debit to bank account 20,000. So next, the date is 31st December. So 31st December you need to record the depreciation entries. You need to calculate the depreciation. So what is the depreciation entry? Depreciation is a non-cash expenditure, so debit all expenses and losses. So debit the depreciation, and which value is getting decreased? To increase the machinery, see, machinery is the asset, so to increase the asset we need to always debit. Okay, asset will always have the debit balance, so to increase the asset we will debit the asset, to decrease the asset we will credit the asset. Okay, to decrease the asset we will credit the asset, so the entry would be depreciation account debit to machinery account. So from the working note in the year 2004, what are the machineries you are having? What is machinery 1 and machinery 2? So from the working note, see what is the amount of depreciation for the machinery 1. So for the machinery 1, the depreciation is 2250 for the year 2004, and for the machinery 2, the depreciation is 500. Okay, these figures I have taken from the working note for the year 2004. So 2250 plus 500, the total amount of depreciation for the year 2004 comes to 2750. Okay, so like this you need to calculate, and this balance is you need to take to the ledger, that is to balance carried down by balance brought down. Okay, like this you will take into the ledger, right? So for this sake, I have given the balances over here. So the balances as on 31st December 2004 is this. Also you can take it from the working note only. Okay, in the working note, what is the amount you are getting? That is 30,000 minus 2250, that is 27,750, plus for the machinery 2 you are getting 19,500. So adding this both, you will get 47,250 as a balancing figure that should be carried down to the next year. Okay, so for the next year you need to record. So see the line diagram again. So as on 1st January 2005 there will be no entry, and as on 1st July 2005 you are purchasing machinery 3. Okay, so for the purchase of machinery 3 you need to record the entry, that is machinery account debit to bank account 10,000 rupees. Okay, 10,000 rupees. And what is the scenario in the line diagram again? That is 31st December 2005, that is the due date for depreciation. So now you have to take the depreciation for 3 machineries, that is machinery 1, 2 and 3, right? So for again seeing the working notes of machinery 1 and machinery 2 and machinery 3, the machinery 1 you will in the working note we got the depreciation of 3,000, and machinery 2 we got the depreciation of 2,000, and for machinery 3 we got the depreciation of rupees 500. Okay, totaling this we will get 5,500 as a total depreciation. Again you need to take the balances as a net cost of the machinery from the working notes only. Okay, from the working notes you can see 24,750, 17,500 for machinery 2 and 9,500 for machinery 3. Total comes to 51,750. So this 51,750 you can directly take it to the ledger. Okay, so and from the start of 1st January 2006, on 1st January 2006 what is happening, that we are selling the machinery. We are selling the machinery 1. So on selling of the machinery 1, 1/3 of the machinery. So what is the amount of machinery we are selling? That is 8,250, right? See what we are getting in return, that is bank balance of rupees 3,000. We are selling the machinery for rupees 3,000, so we are receiving some money. So bank account debit what comes in, that is bank account debit 5250 is the loss on machinery 1. See, 8,250 is the cost we incurred for the machinery 1, but we are selling for only rupees 3,000. So the remaining amount is 5250, that is loss only for us. So debit all expenses and losses. So debit profit and loss account, debit 5250 to credit what goes out. Machinery is the real account, so credit what goes out to machinery account 8250. So whole entry will be bank account debit 3,000, profit and loss account debit 5250 to machinery account 8250, right? So like this you need to record the entry. So machinery account is on the credit side. You will credit the ledger of machinery with rupees 3,000 as bank account, and with rupees profit and loss account 5250 on the credit side of the machinery account. Okay, so next comes to 31st December 2006. Okay, so on 31st December 2006 what is happening? See here, in case of machinery 1 we need not calculate the depreciation for the year 2006 for the amount which we are selling. We are selling 10,000 amount of machinery, right? So we need not calculate the depreciation because we are selling the machinery as on 1st January 2006 itself. We don't have that 10,000 amount of machinery for any month in the 2006. So that is the reason we are not calculating the depreciation for the machinery 1, that is of the 1/3 of machinery 1 in the year 2006. So directly we are taking the sale amount and loss amount. Okay, and for depreciation also we will not consider that 10,000 rupees, because we are selling as on 1st January 2006 itself. We are not having that machinery in any month in the year 2006. Okay, so the entry would be the depreciation account debit to machinery account. So machinery 1, 2, 3, see the working notes, you will get the depreciation amount for the third year. That is for 2006, see the working notes, that is 2000, 2000 and 1000 for the three machineries, which comes to 5000 as depreciation. And this balances also, see from the working note itself, you will get this balances. So this 38,500 you need to carry it down to the next year, that is 2007. So if you, by seeing these journal entries, if you prepare the ledger, that is, if the machinery is on the debit side, you need to debit the ledger of machinery. If the machinery is on the credit side, you need to credit the machinery account. Okay, like this, if you see the journal entries and if you prepare the ledger, you will get to know the balances also. Okay, ledger I did not prepare here, so till here I completed the explanation. Ledger is from your side, you need to prepare the ledger. Okay, so we have completed problem number 1. So let's continue with problem number 2. Problem number 2. Problem number 2. Messrs. Subha Pharmaceuticals has imported a machine on 1st July 2004 for £8,000 or rupees 1,60,000. £8,000, it means they have imported the machinery from outside country. So they are purchasing the machinery from outside country by making the payment in pounds, but they have given the converted amount, that is rupees 1,60,000. So we will prepare in rupees only, so we need to consider the amount of rupees 1,60,000. Okay, and paid customs duty and freight rupees 80,000 and incurred erection charges rupees 60,000. So this 80,000 and 60,000 is the part of purchase of machinery 1. So it is a part of purchase of machinery 1, so it will be included in the cost of the machinery. That is, this 80,000 and 60,000 customs, freight and erection charges is a part of purchase of machinery. So without this we cannot purchase the machinery, right? So it is totally dependent cost on the machinery purchase, so it will be added to the cost of the machinery, this 80,000 and 60,000. Okay, and another local machinery costing rupees 1 lakh was purchased on 1st January 2005. On 1st July 2006, a portion of the imported machinery, that is machinery 1, what we have imported, value 1/3, got out of order and was sold for rupees 34,800. So similar to the problem number 1. So in the year 2006, on 1st July, we are selling 1/3 portion of the machinery 1, that is 1,60,000 into 1/3. Okay, so 1/3 of machinery 1 we are selling for rupees 34,800. So for this we need to make some separate working note. Okay, another machinery was purchased to replace the same for rupees 50,000. So this another machinery has been purchased to replace the machinery 1. Okay, so it is a machinery 3. This another machinery we will name it as machinery 3, because it is a separate machinery they are purchasing now again because of the sale of machinery 1. So this machinery 3 costing rupees 50,000 on the same date, that is on 1st July 2006 only. So depreciation is to be calculated at the rate of 20% per annum on straight line method. Show the machinery account for 2004, 2005 and 2006. Okay, in this case they have given the years 2004, 5 and 6. It means if they would have given 2004 to 2005, 2004, 5, 5, 6, 6, 7, then we need to consider the accounting year. Accounting year means what? That is from 1st April of this year to 31st March of next year. Okay, if they are giving only 1 year in the question, that is like this, that is 2004, 2005 and 2006, it means we need to understand that this is a calendar year, that they are representing the calendar years. That is only 2004. See, from 1st January 2004 to 31st December 2004, from 1st January 2005 to 31st December 2005, and from 1st January 2006 to 31st December 2006. Okay, if they have given 2004 and 5 and 6 and 7, means from 1st April 2004 to 31st March 2005 will be one accounting year. Okay, so like that you need to understand. So here they have given only 1 year, that is 4 5 6, like this. So you need to prepare the depreciation, and what is the due date for the depreciation, based upon the calendar years. What is the due date? That is 31st December 2004, same like previous question. Okay, so here they do not ask directly that prepare for the accounting year, prepare for the calendar year. This is the hint you need to understand. If they give like this, you need to take it as a calendar year. If they give both the years, that is 4 and 5, means you need to consider it as from 1st April of this year to 31st March of next year will be the will be the accounting year. Okay, in this question they are asking based upon the calendar years, that is from 1st January to 31st December, means both in the same year. Like this you need to remember. So depreciation at the rate of 20% on straight line method means you need to calculate the depreciation on the original cost of machinery, on the original cost of machinery. So now let us start with the solution. So what I told you as a part of solution, first you need to prepare the step 1, that is a line diagram, that is line diagram. So here what they are asking, that is for calendar year, so we need to prepare the line diagrams taking 1st January to 31st December. So from starting of 2004, that is 1st January 2004, we have purchased machinery 1 on 1st July 2004, right? So in the year 2004, on 1st July 2004, machinery 1 costing 1,60,000 plus custom duty and erection charges will form part of the cost of machinery. So 80,000 plus 60,000 also come as a part of machinery only, that comes to 3 lakhs rupees. Okay, machinery 1 costing rupees 3 lakhs. And next is the due date, that is 31st December 2004, because the second machinery we have purchased in the year 2005, that is on 1st January 2005. So in the year 2004 there is no other transactions, so 31st December 2004 will be the due date for machinery 1 depreciation. And next, that is 1st January 2005, we have purchased machinery 2 costing rupees 1 lakh, and in the year 2005 there is no other transactions. Next, we are having the due date of 31st December 2005. So on this date we need to calculate the depreciations for machinery 1 and machinery 2 both. Okay, next comes to 1st January 2006. So in the year 2006, what you are doing, on 1st July 2006, a portion of imported machinery was sold, that is 1/3. So what is the first thing you are doing on 1st July 2006, that is 1/3 of machinery 1 sold for rupees 34,800. And the second thing what you are doing, you are purchasing another machinery. Okay, you are purchasing machinery 3 for rupees 50,000. Okay, so and there is no other transactions in the year. So next is the due date, that is 31st December 2006, on which date you need to calculate the depreciation for all the machineries. Okay, so next step is making the working notes for each and every machinery. So as a part of working note 1, that is calculation for machinery 1, what is the see the line diagram now again. So what in case of machinery 1, what is happening, in which year what is happening. Okay, so in the year 2004, on 1st July 2004, we are purchasing the machinery 1 for the rupees 3 lakhs. Okay, 3 lakhs. Next, that is the due date, that is 31st December 2004, we need to calculate the depreciation. So from 1st July 2004 to 31st December 2004, how many months? 6 months. So for this 6 months you need to calculate the depreciation. So 3 lakhs into 20% into 6 divided by 12, which comes to 30,000 as depreciation. So what is the balance amount you need to carry it down in the balance sheet? That is you need to carry it down for the next year, that is 3 lakhs minus 30,000 depreciation equals to 2,70,000 as on 31st December 2004 or 1st January 2005. the balance of machinery 1. So in case of machinery 1, in the year 2005, is there any changes? No, there is no changes. So in this year 2005, you can take other as usual depreciation for full year, that is 3 lakhs into 20% into 12 divided by 12, which comes to 60,000. Okay, so 2,70,000 minus 60,000 is the balance amount as on 31st December 2005 or 1st January 2006. That is 2,10,000. Okay, so 2,10,000. And next, what we are doing? As on 1st July, we are selling 1/3. 1st July 2006, we are selling 1/3 of the machinery of machinery 1. So 1/3 of machinery 1 we are selling. But what is happening here, from 1st January 2006 to 1st July 2006, that is 6 months. January, February, March, April, May, June. So 6 months we are holding the machinery 1/3 part. 1/3 part of machinery 1 we are holding for 6 months in the year 2006. So for this 6 months we need to take the depreciation on machinery 1/3 portion. Okay, so for 1/3 portion you need to calculate the depreciation at the rate of 20% for 6 months. So 1/3 of 3 lakhs is what? 3 lakhs. Out of this 3 lakhs, 1/3. So 3 lakhs into 1 by 3, which comes to 1 lakh. So 1 lakh into 20% into 6 divided by 12. 1 lakh into 20% into 6 divided by 12, which comes to 10,000 rupees. So this 10,000 rupees is the depreciation you need to deduct from the working note. You need to deduct from the net cost of the machinery. Okay, and next, what is the amount of you need to deduct from the machinery? That is remaining balance, means 1/3 you are selling. So 3 lakhs minus 1 lakh, that is going out. So 3 lakhs minus 1 lakh, 2 lakhs. The 2 lakhs amount you are holding for the full year. The 2 lakhs amount is with you only now. So for the 2 lakhs amount you need to take the depreciation for the full year, right? So 3 lakhs minus 1 lakh, you are eliminating the 1/3 portion now. So, and you are calculating the depreciation for full year for the separate 1/3 portion, for the other than 1/3 portion. Okay, for 1/3 portion you have calculated for 6 months. Okay, and again for the remaining portion, that is remaining balance out of 3 lakhs, 3 lakhs out of 3 lakhs you eliminate the 1/3 portion, and on the balance, that is 2 lakhs, you need to calculate the depreciation for the full year, because you are not selling the remaining balance, only 1/3 you are selling. So for 3 lakhs minus 1 lakh, 2 lakhs, you need to calculate the depreciation for full year, which comes to 40,000. Okay, and for 1/3 of the machinery 1 you sold on 1st July 2006, you need to calculate this separately. So just do the separate working note, that is value of machinery 1 for sale is 1 lakh, that is 3 lakhs into 1 by 3 comes to 1 lakh. Okay, for this 1 lakh, it is 1 lakh amount in the year 2004. But if we take the depreciation, we are taking the depreciation every year, right? So for as a same, then you need to take the depreciation for this 1 lakh. If you take the depreciation for 2004 for 6 months, it will come around 10,000. And next is the amount 90,000 you will get as the net cost. And next year 2005, you need to take the depreciation for 12 months. Okay, so for 12 months you are taking the depreciation 20,000, and you will get the amount of rupees 70,000, and 70,000 as on 1st January 2006. Okay, so for on 1st January 2006 you are not selling this. On 1st July 2006 you are selling. So for 6 months you are holding this 70,000 amount with you, amount of machinery with you. So for this 6 months we have calculated the depreciation, right? So in this 70,000, that is 1 lakh into 20% into 6 divided by 12, which comes to 10,000. Okay, for 6 months you need to calculate the depreciation. So as on 1st July 2006, you will get the amount rupees 60,000. So this 60,000 you need to eliminate from the total cost of the machinery. That is, in the working note 1, you need to take this 60,000 amount as on 1st July 2006. You need to eliminate this 60,000 from 2,10,000 net cost. So after deducting all this, that is 2,10,000 minus 60,000 minus 10,000 depreciation for 1/3 portion and minus 40,000 depreciation for the whole amount of machinery, balance amount of machinery, and the balance you will get at as 1 lakh as on 31st December 2006. Okay, and next comes to the working note of this a machinery one sale thing. So you are getting 60,000 as on 1st July 2006. Okay, this 60,000 costing machinery you are selling only for rupees 34,800. So you are in loss. You are in loss. So you are getting the loss on sale of machinery rupees 25,200. Okay, rupees 25,200. Okay, till here we have completed the working note of machinery 1. So next the working note of machinery 2. We have purchased machinery 2 in the year 1st January 2005. So cost is 1 lakh. So 1st January in the year 2005 we are holding this machinery for 12 months. So take the depreciation for full year, 1 lakh into 20%, 20,000, and for the next 2006 year also we are holding the machinery 2 for the full year. So take the depreciation for the full year. So like this you will take the depreciation for 2 years and you will calculate the balance amount. Okay, so the next one is machinery 3. So machinery 3 you are purchasing in the year 1st July 2006, that is 6th 2006 you are purchasing this machinery for rupees 50,000 and you are holding this machinery only for 6 months. Okay, from 1st July 2006 to 31st December 2006 you are holding this machinery only for 6 months. So you will calculate the depreciation as 50,000 into 20% into 6 divided by 12. You will get rupees 5,000. So balance will be 45,000. Okay, and the next, see the line diagram, record the journal entries. See the line diagram, record the journal entries. So by seeing the line diagram, on 1st July 2004 you are purchasing the machinery 1. So machinery 1 account debit to bank account 3 lakhs, and on 31st December what is happening, you are calculating the depreciation. So see the working note 1 and take the depreciation amount of machinery 1. Depreciation account debit to machinery 1 account 30,000. Okay, so the balance as on 31st December 2004 is 2,70,000. And in the year 2005 what is happening, on 1st January 2005 you are purchasing machinery 2. So machinery 2 account debit to bank account 1 lakh. And next, no other transaction. So as on 31st December 2005 you need to take the depreciation for machinery 1 and machinery 2. Depreciation account debit to machinery account. Machinery 1 60,000, machinery 2 20,000. Take it from the working notes. Okay, so you will get 80,000 as a total depreciation. And next balances you will get from the working notes only. Machinery 1 2,10,000, machinery 2 80,000. Okay, in the year 2006 what is the journal entries? 1st July 2006. As on 1st January 2006 there is no transactions. So on 1st July 2006 you are selling the machinery. So what is the cost of machinery you are selling? That is 60,000. If you see the working note you will get the 60,000 how we have calculated. So bank account debit what we are receiving, that is 34,800. Profit and loss account debit we are incurring loss of 25,200. To machinery account 60,000. These figures you will get it from the working note. Okay, and on 1st July 2006 what we need to do, we need to take the depreciation of this machinery 1, because this machinery 1 is not with us. This machinery 1/3 of the machinery 1 we are not holding it for the full year. We are holding only up to 1st July 2006. So it is for 6 months. So that for 6 months we need to calculate the depreciation from 1st January 2006 to 1st July 2006, 6 months. So you need to calculate the depreciation, that is 3 lakhs into 1 by 3, which comes to 1 lakh. 1 lakh into 20% into 6 divided by 12, which comes to 10,000. Okay, so on 31st December 2006 you need to take the depreciation for all the other remaining machineries we are having. So depreciation account debit to machinery account. Machinery 1 other than 1/3 portion we are having, right, 2 lakhs. So on that 2 lakhs we are getting 40,000, and remaining machinery 2 and machinery 3 20,000, 5,000. So total comes to 65,000. So balances we will get from the working note only, that is 1,60,000, 1 lakh for machinery 1, machinery 2 60,000, machinery 3 45,000. So total 2,05,000 will be the balances. Okay, so from here you need to record the ledgers. So ledgers you are having in the textbook only, you can revise from there, or else you can do it on your own also. If the machinery is on the debit side, you need to debit the ledger of machinery. If the machinery is on the credit side, you need to credit the machinery with the remaining whatever the items you are having on the opposite side. Okay, I hope till here everything is clear. So let's continue with problem number 3. Okay, let's continue with problem number 3 from your textbook. So problem number 3, Metropole Limited acquired a machinery for rupees 5,40,000 on 1st April 2004. Depreciation was to be charged 20% on straight line method, that is 20% on original cost always. During 2006 and 7, a modification was made to improve its technical reliability at a cost of rupees 50,000, which it was considered would extend the useful life of the machinery for 2 years. So this cost is totally dependent upon the machinery, because it is improving the machinery's life, because it is improving it is bringing some improvement in the machinery. So it will be treated as a cost of machinery, and it will be added to the cost of the machinery in the year 2006 and 7. Okay, and next is which is to be okay, at the same time an important component of the machinery was replaced at a cost of 10,000. Okay, we are incurring some component cost, that is we are purchasing some other component to replace the old component in the machinery. That will also improve the machinery's working, because the part of the machinery we are replacing with another component, that is amounting to rupees 10,000. So it is also a part of cost of the machinery. So this replacement cost will also be part of the cost of machinery. And routine maintenance during the said accounting period cost rupees, routine maintenance 7,500. This routine maintenance we incur every year, so it will not form part of the machinery's cost, because it is not a capital expenditure, it is a revenue expenditure. Because we will incur this routine maintenance expenses every year. It is not a one time expenditure, it is every year expenditure. So it will go to the profit and loss account on the expenditure side. Okay, so we will not take this maintenance cost to the we will not add this to the cost of machinery. Okay, so show the machinery account, provision for depreciation on machinery account, and the charge to profit and loss account for the year ending 31st March 2007 only. Okay, they are asking only for 2007. We can make the journal entry, so afterwards you can take it to the ledger accounts. Okay, so as a part of this question we need to do the solution starting from the step 1, right? So what is the step 1? We need to draw the line diagram to know the scenario of the question. So from the question, draw the line diagram, that is 1st April 2004 we are purchasing the machinery, right? So they have not told anything, they have used for the year ending 31st March 2007 in the question. It means we need to take the accounting year, that is from 1st April of this year to the next 31st March of the next year. So it is called accounting year, right? So in the question also they have used for the year ending 31st March. So from this we can say that we need to use the accounting year. So in the line diagram, what are the dates you will use? That is from 1st April the year will get started, and the year ends on the 31st March in the next year. So in the line diagram, 1st April you need to take first. So 1st April, what is the transaction we are doing? That is we are purchasing machinery costing rupees 5,40,000. So next they have given the depreciation, that is 20%. Okay, I have taken note of this. Okay, the next thing is in the during 6-7. So it means from 1st April 4 to 31st March 2005 there is only one transaction. And in the year 5-6, that is from 1st April 2005 to 31st March 2006, there is no transactions occurring. They have given directly during 2006-7. Okay, so in the question they have given directly 2006 and 7. So it means 5 and 6 there are no transactions. So in the year 5 and 6 only we need to take the depreciation as on 31st March 2006. There is no other entries other than depreciation. Okay, so on from 1st April 2006 to 31st March 2007, during this year we have incurred the improvement cost of rupees 50,000 and component cost of rupees 10,000, right? So component cost and improvement cost total amounts to 60,000, and the routine maintenance we are incurring 7,500 during the accounting period 2007, 31st March 2007. Okay, so note 1, you can take the note 1 here, that is routine maintenance of rupees 7,500 is not the capital expenditure, therefore it do not form part of cost of the machinery. It will be transferred. T by F is transfer, shortcut for the transfer. So T by F transfer to the P&L account. So what is the entry if we incur the maintenance cost? First thing is maintenance cost is expenditure, so debit all expenses and losses. So maintenance cost account debit to bank account 7,500, right? So maintenance cost account debit to bank account 7,500, and this maintenance cost where we will charge to the profit and loss account debit side. So if we charge this maintenance cost to the profit and loss account debit side, so the profit and loss account should be on the debit side, right? So the profit and loss account should be on the debit side. If you prepare the profit and loss account, maintenance cost will come on the debit side of the profit and loss account. So if you prepare the profit and loss account, it will come on the debit side, so you need to debit the profit and loss account. Profit and loss account debit to maintenance cost account, what is the amount? 7,500. So we have sided this 7,500. Okay, we have kept aside. So keep aside this routine maintenance expenditure. It will not come in the this depreciation machinery account, and as I said you, it will not form part of the machinery account. And it on this, if we consider it as cost, then only we will calculate the depreciation, right? So it means it will not come to the machinery, and it will be not considered in the depreciation ledgers also. Okay, so keep aside this maintenance. Give a note like this if you have get this question in the exam. So please give a note like this, it is enough. Okay, so giving this note is important because they have asked in the question that routine maintenance is incurring in the accounting year, so and so accounting year. So you need to give a note part like this, and next you carry forward to the question, that is for 1st April 2004. What we are doing? So here there is nothing to calculate. Okay, if you can do the working note as well. If you do the working note, the cost of the machinery, see, if first take a working note, that is calculation of depreciation on machinery. A cost on machinery of 1st April 2004 is 5,40,000. So depreciation for the year 4-5 we are getting 20%. Okay, for full year we are holding this machinery, that is from 1st April to 31st March, right? So for full year we are in holding this machinery, so we need to calculate for the depreciation for full year, that is 5,40,000 into 20% into 12 divided by 12, which comes to 1,08,000. So if we deduct the depreciation from 5,40,000, you will get the balance of rupees 4,32,000. And in the year 5-6 also you have no changes to the machinery one. So depreciation for the full year you need to take, that is same 20% on 5,40,000, you will get 1,08,000. Okay, again you will get the balance of rupees 3,24,000. Okay, so in the year 6 and 7 you are incurring the improvement cost and the component cost, that is 50,000 and 10,000, so which comes to 60,000. So this cost you need to add to the machinery, right? So this amount of cost of improvement you need to add to the machinery, that is 3,24,000 plus 60,000. So the total cost of the machinery in the year 2006 and 7 you are getting is 3,84,000. So now the original cost we will consider is 3,84,000, because we are incurring some expenditure, so we will consider this cost now. So the cost of improvement, after adding this cost of improvement, you will get the cost of machinery as 3,84,000. So on this 3,84,000 you need to calculate the depreciation. Okay, so if you calculate the depreciation for the year 6 and 7, for full year we are holding this machinery, right? So depreciation 3,84,000 into 20%, you will get 76,800 as depreciation, and the balance amount 3,07,200 we will consider it in the machinery account. Okay, we will consider it in the machinery account. So if you see the journal entry part, on first see the line diagram again. On 1st April, what we are doing, we are purchasing the machinery. So what is the entry? Machinery account debit to bank account 5,40,000. Okay, and for the year to 6 and for the year uh, okay, depreciation entries, if you see the depreciation entries, you will get the they have asked the provision for depreciation account to prepare the provision for depreciation account, right? So now if they are asking provision for depreciation, we will not record the depreciation to machinery. We will not record the depreciation to machinery. We will record depreciation to provision for depreciation account. We will create the provision means the credit liability, right? So we will create the provision. So first see the part of machinery only. So 1st April you are incurring 5,40,000, and in the years 2006 and 7 you are incurring 60,000, that is 50,000 and 10,000. You can record it separately. Machinery account debit to bank account 50,000, machinery account debit to bank account, in the bracket you can write it as improvement cost and replacement cost. Okay, so machinery account debit to bank account improvement cost 50,000, or machinery account debit, in the bracket you can write replacement cost 10,000 to bank account, like this. You can record a combined entry or you can record the separate entry for both 50,000 and 10,000. Okay, so after this you need to record the depreciation entries, right? For the depreciation, what they have asked, to prepare the provision for depreciation ledger. So for the year ending 31st March 2005, for the year 2004 and 5, the depreciation entry would be depreciation account debit. Okay, depreciation account debit to provision for depreciation. Because they are asking provision for depreciation, to create provision, we will consider provision. We will not consider machinery on the credit side. Okay, so depreciation account debit to provision for depreciation account. What is the depreciation amount for the first year? That is 1,08,000. Okay, so this we will calculate like this. Okay, depreciation account debit to provision for depreciation account. See, ultimately where this depreciation will go, this depreciation will go to the P&L account debit side. So if you debit the depreciation account or if you debit the P&L account, the thing is same. If you debit the P&L account, in bracket you need to write the depreciation. Okay, otherwise depreciation account debit to provision for depreciation account, one entry, and P&L account debit to depreciation, another entry you need to record. P&L account debit, see they are asking the P&L account also, right? P&L account, the charge to P&L account for the year ending. So you can record the separate entries, like, see, take a note of it. I have not given here. Depreciation account debit to provision for depreciation account, one entry. Okay, and next entry is P&L account debit to depreciation account. If you prepare the P&L account, depreciation will come on the debit side of the P&L account. So now you have to debit the P&L account, P&L account debit to depreciation account. Okay, depreciation account debit or to provision for depreciation account, or else in this entry only, like I have given here, slash P&L account debit. Okay, you can directly take it as a P&L account debit to provision for depreciation account, or you can record two entries, that is, see, first entry is depreciation account debit to provision for depreciation account. Okay, so this depreciation where we will transfer to the P&L account. So the next entry will come as for P&L account debit to depreciation account. So one debit of depreciation and one credit of depreciation, so depreciation will cancel. So ultimately what we will have, P&L account on the debit side and provision for depreciation on credit side, right? If you record that two entries, it will be the same. or if you record directly as P&L account debit to provision for depreciation, it will be the same. See, if you write that entries and you compare. First entry is depreciation to provision for depreciation, and P&L account debit to depreciation. Okay, and now you cancel, depreciation of the first entry debit side you cancel, and depreciation now on the credit side, that is P&L account entry. In the P&L account entry you cancel the depreciation account. So ultimately what you will be left with, that is P&L account on the debit side and provision for depreciation on the credit side, right? Or else you can record the direct entry, one entry, that is P&L account debit to provision for depreciation account. Okay, that is 1,08,000. So the next one is for the year ending 31st March 2006, same like that only. Depreciation account debit to provision for depreciation account, one entry, and the second entry would be P&L account debit to depreciation account, that is one entry. Okay, and the next thing is you can take it to the P&L account debit side. Only the direct entry, that is profit and loss account debit to provision for depreciation account, that is only the one direct entry. You can record the both two entries as a part of the entries. You can take it two entries, or you can take a direct entry. Both will be the same. Okay, because of that I have gave the slash over here. And for the year ending 31st March 2007, same entry, that is 76,800 is the depreciation amount. From the working note you will get it. So record the same entry and you prepare the provision for depreciation account. They are asking the machinery account and provision for depreciation account, right? So seeing these journal entries, you record the in the ledger. Provision for depreciation is on the credit side in all the entries, so you will credit the P&L account or the depreciation account. See you all in the tomorrow's session. Please hit the like button and subscribe button, and please on your notifications bell icon, because you will get the notification whenever I post the new videos. Okay, and please comment your views on my video. Okay, if you like and comment on the videos, then only my video will get circulated to so many students like you.